Hello, hi. This is my third video on foreign exchange market and trading currencies. I hope you all are trying to understand. But before directly moving into the currency trading, we need to understand who all are the participants in the market and how the currencies are traded. So, unlike equity, foreign exchange market has more number of participants. We can see from central banks to corporates to banks to travelers to traders. In equity, only traders and investors mostly they participate in equity market, but in foreign exchange market, there are many participants and they have their own objectives. Like travelers, maybe from India wanting to go to America, wants to exchange rupees in dollars, or the US citizen wanting to come to India want to exchange dollar in rupees. In the same manner, central banks might have its own objective of controlling money market operations, or corporates or banks who want to hedge. So different participants and different objectives in the foreign exchange market makes foreign exchange market one of the most liquid and largest market in the world. But the most important thing that is to be understood is that there is no any centralized international exchanges, but foreign exchange takes place in a different financial institutions like national stock exchange in India. The other most important point which we need to understand is that the information flows freely from one country's platform to another, making it completely borderless. You can see in this picture a market is open, foreign exchange market is open in India, but it is closed in Chicago. So, trader in Chicago might be watching the Indian market, and when Indian market opens, when Indian market closes, the trader in Indian foreign exchange market might be watching the market in Chicago, which is already opened. So this market is 24 into 7 market. It's one of the largest market, and the turnover is in $1 trillion. So before jumping into the trading, I'm again telling one need to understand the basic terminologies which are normally used in the foreign exchange market. One is currency pairs. Understanding currency pairs is very simple. Whenever anyone trades in the foreign exchange market, they when they buy currency pairs like USD dollar, INR, Indian rupees, or Great Britain pound INR, USD INR, or GBP INR. So this currency pairs has a standard format which is known as base currency and quotation currency. So base currency divided by quotation currency will get the value. So let us not complicate it. USD slash INR is equal to 76 is simply means that base currency is always fixed to 1. So 1 USD is equal to 76 INR. So I hope you understood what is currency pairs. So in foreign exchange market, buying and selling of currency pairs is very much famous, or it's a common terminology which is used. Let us move on to the other slide. You can see these are the four major foreign exchange pairs which are traded in large volumes, and these are euro dollar, dollar yen, pound dollar, dollar Swiss franc. The value of currency pairs moves into very different directions. It's very much volatile. So the next question is, what makes the value of currency pairs move? For that, we need to have a dual view. So trading in currency is different from stocks. Say for example, anyone who is buying the shares of SBI is expecting the share price to increase and vice versa. But the story is different when anyone is trading in the foreign exchange market, because when anyone who is buying the currency pairs has a dual view. Say for example, Mr. X is buying currency pair USD INR. He's expecting USD to increase and INR value to decrease. So if they are selling it, they are expecting USD to decrease and INR to increase. This is a dual view. Why this is so is because one currency is quoted against another currency in foreign exchange market. So let us explain it with the help of an example. In time 1, currency pair USD INR was 76, and in time 2 it increased to 79. So why the value of currency pair is increasing is because um, the value of base currency increased and the value of quotation currency decreased, or USD in value of USD increased and value of INR decreased. So this is how the currency pair moves, but it will be opposite if you know the USD value decreases and INR value increases. The value of currency pair USD INR will decrease. It will be lesser than 76. So the concept of the having the dual view and currency pair is very much important when you are trading in currency or foreign exchange market. So there is another concept of two-way quote. So if you want to understand what is quote is the price at which anyone buy or sell the currency pairs. You can see the red arrow. There are two currency pair. One is USD INR, another is EUR USD. So I explained what is quote. Quote gives us the rate at which anyone can buy and sell the currency pairs. So normally, and anybody who enter into the foreign exchange market, they see two quote, bid quote and ask quote. So if the trader wants to buy the USD INR pair, they'll have to check the ask quote. So but we need to remember about the dual view concept. This ask price 76.2055 is going to increase only if the USD is increasing and the INR value is decreasing. So when any trader wants to sell, have to check the bid price. So whenever they are selling, they will be in profit when the USD value will decrease and INR value will increase. So this is the concept of two-way quote. So trading in currency market is a little bit different as compared to the equity market. Now let us try to see, sometimes what happens is that these quotes are quoted in short form. Like you can see it's quoted 76.2050 slash 55. So if it is written in this way, one need to understand that this is just the bid and ask price. So um, bid is always the numerator and written in full, and the ask price is always the denominator, and only the last two digits are written. So the another point which is very much important for the trader to understand is pips. So understanding pip is very simple. Say for example, as I've already explained, any trader who wants to buy will have to check the ask price. So when they are buying the currency pair, say for example USD INR, they're expecting USD to increase and INR to decrease. So if this happens, then ask price will increase from 76 to 76.2060. The value of currency pair is increased by 0.005, which is normally known as 5 pips. So if it happens, so normally traders say that USD INR pair has moved by 5 pips. So normally pips is just a change in the last digit and the value of the currency pair. So I hope you understood this concept. And in the next video I will show you how to buy and sell the currencies and how to use the NSE National Stock Exchange platform also. So any doubts you have, you just write in the comment box. I will try to explain it. And till the next video comes, you stay safe and stay tuned. Thank you.